So we are in financial reset right now. This is a financial default trade. It is a debt-based fail. You go gold. Everybody's going to have less. They're going to spend less. They're going to buy less. So it's a debt-based collapse. That's what everyone has to realize. Your government is your biggest enemy. Right now, your government and their policies are all designed to trap you, strip you, and contain you. It's totalitarianism, it's financial warfare, it's going to turn physical and social, and in the UK and in Germany and many countries you're already seeing this. Debt-based collapse affects everything. It is the foundation of Ponzi scheme that has been constructed. And that's why this gets worse. That's why there's no melt up. And that's why it's still early in the gold trade. It's not too expensive because every extra person that we get to buy a gold ounce is one rioter and angry social mobster that's now become onto outside of the team.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexej Jordanov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. It's great to have Francis Hunt back on the podcast. This time, I don't have the pleasure to be sitting next to you on this beautiful view outlooking Cape Town, but it's nonetheless always a pleasure to be able to speak with you, Francis. We were talking about your thesis, about the way you trade, your whole analysis about the markets, the end of the 40-year debt cycle, the fact that we are entering a macro deleveraging phase, the fact also that we have all the symptoms and signs flashing that we will witness a period of hyper-stagflation in the coming decade. All of that can be viewed on our last interview. And this interview is a bit of a follow-up, taking into consideration that we have plentiful amount of topics to discuss because things happened within this last 5 weeks. Obviously, the elephant in the room, the tariffs, the trade war, all of that. So maybe first, I would like to hear your analysis about how do you make sense of this current trade war, and then we will also then segment the consequences of that, because I do believe that this is the beginning of a profound shift in terms of what we see in the monetary regime that we have in the constellation on the geopolitical level and monetary level. So take it away, Francis.
Yes, thank you. And, following, you did a great series, by the way. Congratulations to Freedoms of Finance. And it was very popular and lots of people saw it. And if you're watching this interview today and you haven't seen those, please go and watch them. But one of the key things we start with, and we start every time, it's about the debt, and it's a debt-based collapse. We highlighted previously that Doggy, Elon, and all the searching for cuts is all about the fact that the overdraft, the bottomless overdraft, has been pulled on America, and they now actually have certain limits because of their ability to create a debt asset and pass it to someone else. The desire and the demand is no longer there to the same degree that it once was, following the turn of our biggest call, the 2020, in late 2020 bond market turn. We said, that's it. That's the 40-year bond market. Now, that's the other half that has to be bought. That's somebody's asset every time you borrow the liability of money into existence. And when that base pyramid crumbles, you'll also remember the one distinction between me and Henrik is he felt there'd be another melt up to come. And we say, no, there's no place for that money to be created anymore. It's all about debt, and there's a walking out on debt. We've seen more detail come in on that. For example, 42% of US mortgages are being rejected, including refinances. That is huge. 36% of car auto loans are being rejected. So what that points to at a retail level and a small man on the street level is that the originators of debt instruments don't have the same desire to create that. Compare that to sort of 2006 and 7 when they all had the auto bots signing for welfare check people and the ninja loans. You get the contrast of there was a massive securitization. People got to sell on that debt, stamp it as AAA, regardless of how it was then. Of course, the rating agencies were part of the big lie, and there was a consumption of it in the search for yield. So we existed in that era in the search for yield. It was about return on capital. And now we've pivoted since 2020. And we were the early callers on that. But you saw Druckenmiller, and I referenced him, and Paul Tudor-Jones in November of 2024. I referenced them in March when we were chatting, how they've now talking their book about being short on TLT, which is a long-term debt instrument. So now it's no longer return on capital, it's guaranteeing return of capital, which is where gold comes in as the reserve asset, and that's why we run. And our point being that we didn't feel there would be another melt-up, as Henrik was maybe putting forward, is because there's no appetite for quantitative easing or anything that could bring in a wall of liquidity. That's the creation of money. That means easy borrowing. And the environment's going in exactly the opposite direction as I've illustrated. And in fact, the retail housing market in the US is going to go into a bad downturn. And this is going to continue. Subprime loans are going to become part of the feature. And I'm expecting this then, the next stage of all of this is going to turn into banks, hedge funds, and bankruptcies or credit events. So we're currently in the tariff label, but some people will say, oh, but Trump did this and it's all Trump and the tariff. So they can put a label. It's called recency bias. It's almost like you got a bad guy and you got a dumb policy and he did this all. Actually, they have no room to move. People have forgotten, and we referenced again previously, that there's $9 trillion that has to be rolled before they even spend their first dollar on the new fiscal year. That means new people have to be happy purchasers of debt. So many have philosophized, well, maybe he's forcing the recession to try refinance that at a lower rate. Most of that debt was financed at very, very low rates, 2s, 2.5s, and 3s. And now he's looking at having to finance it substantially higher. So the lower they get that, the better. But either way, America's interest rates payments are going even steeper up. And that's why everything is about efficiency, cuts, etc., without saying that word cuts. In the military, we also showed a slide where, the head of the military was saying anybody who's not core frontline is no longer really needed or required. America used to have something ridiculous. For every man in the field, there are double digits of people in support for one soldier on the ground. So all of this that's the direction, and the process has started. And now it's become America saying, well, you've got some spinners saying it's a burden on us. The exorbitant privilege is a burden on us, and people should pay us for being the sole currency holder. This is all kinds of witchery and magic. They had the exorbitant privilege. They've abused it. Things have turned and nobody wants the debt anymore. And now they have huge deficits. They don't have much in manufacturing. And by the way, assembling iPhones, it's not bringing that back on land is not what's going to save them. The key thing is China is a major creator, is a producer nation, lives within its means, and has currently, up until recently, supported their dollar treasury system, and that's allowed America to continue. But now it's gone too far, and now everybody wants to fight, and America's trying to force people to dance with them and say it's us or them in a way. And this is part and parcel of we've got a problem, we don't know how to deal with it, and we need a much more beneficial relationship to save us for all our bad habits that have compounded to a critical point. So we are in financial reset right now. And the key penny that dropped And this is something we've made very clear before. We actually did drawings with how bonds work. The interest rates go up, the value goes down. We then showed there comes a point where the seesaw breaks and both the rates go up, which is the bond valuation going down, and the currency goes down. Because normally when interest rates go up, even though your debt valuations go down, you get money flowing in to earn the higher yield. What actually happened recently, which was of grave concern, was the dollar collapsed and the debt collapsed. And we've said it goes in a staircasing way, left foot, right foot in the collapse. But you get an acceleration moment where they both collapse. We had a microcosm with the British pensions crisis, where the pound dropped and the debt markets dropped when Kwasi Kwarteng and Liz Truss, I think it was, were trying to do an expansionary budget that would have led to more debt creation. Which was the right idea, but they just got too much wiggle room. They got thrown under the bus. So here's what, and I said, the day comes when America will have that moment. You've had your first little spot of that happening, and it was in the US tenure. So that's kind of some of the excitement of what's been going on, and I say excitement, it's grim, because the outlook for the average person is not very good. Gold holders, you're in the right place and you're going to do well. But it's, as we were discussing beforehand, it's not something to take too much glee in, because there's going to be a world of pain for everybody else who hasn't jumped on board. And a final thought before I shut up is that when I was sitting with you, one of the key things I said is I'm messianic. I tell taxi drivers and everyone else, because every extra person that we get to buy a gold ounce is one rioter and angry social mobster that's now become onto our side of the team. And I would sooner, not have tons of silver in my own name, have half the amount, and have more individuals with an ounce each that are taking the right thing, and the same with the gold. And that's what we've got to focus. We've got to bring the right people and get more of the masses to help save themselves for our own benefits and theirs.
Totally agree. Is it also, do you think that now talking back to the Fortress America, which Trump is building, when we look at the strategy that they're taking, especially with Scott Bessent, do you think that it's a winning strategy? Like the fact that they are intimidating countries to basically choose either you trade with China or you trade with us. In the long term, one could guess that this is actually quite hurtful, because the trust of the partnership that those countries have with the US as a trading partner also erodes because of this erratic type of behavior. And then there's the gameplay, as you mentioned also before, the idea that the refinancing of this 9 trillion need to be done in a very urgent manner by lowering the 10-year, which is for now not the case, because it has dropped a tiny little bit, but jumped back up to the 4.4, 4.5%. Maybe let's have a closer look, if you have the chart in front of you, about that, and also your full analysis on this whole strategy that is at hand.
So the easy question to answer is no, it's not a winning strategy. Of course not. And there are very few winning strategies from this position. So I've regularly said it's the 747 in a 45-degree turn into the base of the mountain. And you can put the best pilot in the world, but if I hand him the joystick literally 3 seconds before impact, there's very little he can do with a 700-kilometer-per-hour dive into the base of a mountain, no matter how good a pilot he is, no matter how strongly he pulls left, right, or up. It's very unlikely you're getting out of that situation. So it is a losing situation. And inherently, the question actually becomes, how do you choose to lose? Do you try be gracious and work with people and say, listen, and be honest about the state of your situation, beg and plead a little bit? Or do you go on the front foot and try win ridiculous concessions that can get you to limp on a little bit longer? So you come out aggressive and make out it's everybody else's fault. They have a saving problem. We don't have a spending problem. They have a saving problem. They have a production. They overproduce. All kinds of spin narratives, which is just inversion, perversion. And they've gone the inversion, perversion route because they want to remain aggressive and assertive, and they still have a big defense, so they can still intimidate to a degree. But you don't successfully intimidate yourself a great big group of friends. I think you'll agree, socially, that's not the winning policy. How to win people, how to influence and win friends. What was the book again? How to influence people. It's not. Intimidation is not the one. I'm sure someone will drop the full title while I'm all tongue-tied below. And that was an American book, but they're not applying the rules. And the rates, as you saw, we are in a recession, and we should have seen this head and shoulders press on, in actual fact. And we were watching and drawn this. And it did start its break. In other words, real concern about the state of the economy, a little bit of fear driving some bit into the debt. And then boom, when it become escalated and worse, people said, I don't want to be holding debt. And there was a lot of, and I had a long discussion with my community about this, and I say how the mainstream media will spin you a yarn. The first story was, China did this, they sold T-bills. Then they pivoted to Japan and said, it's the Japanese, as if it was an attack. To asset manage your own money and to sell off an underperforming asset is almost like you've attacked America. It's Pearl Harbor again. Listen, first of all, if either of them had done it, they would have been entirely in their rights to do it, because it's a terrible asset and no one should want to hold it. They should all be looking to hold gold. But as it turned out, neither of those two were actually true. And it's actually US institutions inside US. So I was just explaining, when the narrative comes out, China did it, Japan, and then later, no, it seems it might have been Japan. I knew straight away those were probably false dichotomies, because they externalize every time the issue that is essentially a domestic issue. And that's hyper indebtedness with a hyperinflated stock market based off debt. Margin debt, all forms of housing debt, all forms of malfeasance and financial hyperextension. So all these assets have to devalue, and housing and a lot of things, because they were all suspended on debt. You take the cars that they sell, the big Ford trucks at 90,000 with extras on it, and people are taking 7 years to pay for 40% or 50% of the vehicle, and a balloon payment of half the original purchase price. These people shouldn't be driving those cars. You can't afford it. Why are you having it? And those aren't even assets. Those are depreciating assets. They're sort of current assets, which on balance sheets generally are expected to go down. You'd even put computers under the current assets in the days I did accounting, and those are clearly depreciating assets. So what we actually have is a over-borrowed society. They've just over-borrowed in everything. And now they're having to use credit cards to buy pizzas and food. And, that is the worst credit at the most highest cost, which also leads to the greatest bankruptcies. We've seen a rise in bankruptcies, personal bankruptcies, corporate bankruptcies. They're all at near highs. That is why we said there is no melt up from here. There's no melt up from here. The retail is wrecked. In the US. There can't be a melt up from here, and the quantitative easing can't be coming, because they need all of that bid that to go into rolling the 9 trillion. If they start issuing more, an absolute splurge again, well, they don't have the fear. They didn't have when CV19. So here's the thing everybody's got to understand. This is not 1987, 1999, so the 87 crash, it's not the 99, which was the dot-com crash. It isn't 2008, which was the great financial crisis, and it isn't 2020. All of those things had one or two things in common. Rates drop, and liquidity increases, and it just got bigger when we got to subprime. We had 200 billion, 300 billion, 400 billion issued QE1, 2, and 3. We went straight to trillions, because we limped out of the great financial crisis. We went straight to trillions in COVID with stimulus, and they needed to bring the man in the street into it. So they did stimulus and furlough payments. Each time has got ever more volatile. I'm going to come back to that on a chart soon. This isn't any of those events, because the difference is, after 2020, the funding mechanism, the debt market, is broken. It's in a bear market. This is right back to the 70s, only a hyper version thereof, hence our phrase that you mentioned, hyper-stagflation, which means stock market actually goes sideways and mainly down, and definitely down in real terms, at the same time as you have a collapsing bond market, over-indebted from the Vietnam War. And I referenced that when we spoke, how they dropped more bombs than all of World War II. And no one heard about it or felt it because it was in a jungle far, far away. They were making holes in somebody else's ground for the equivalent, I expect today, that BlackRock will be filling up in Ukraine later. So that's where we are in the society. It's a debt-based collapse. And the central banks and their conduct have brought ever greater volatility. And I'm going to show you another chart that will illustrate that. And I think it is this one. Here we go, Dow Jones. So this is the.
Can you share your screen?
Oh, please, yes. I was already doing that.
No.
And we had it on the US 10-year, so I should have shown that with it gets sharing. So this was the US 10-year with the head and shoulders I referenced, by the way. There it was there. And the weakness saw a little bit of a run initially into debt. That was the break that started there. And then suddenly, everybody, once it got too extreme, they didn't want to hold debt. And actually, the rates got rammed up. And at the same time as all of this is mid-April, beginning first 2 weeks of April, we also had the currency going down. So the Dixie, you see the USD JPY there is in a bit of a head and shoulders and heading down. And we also had the dollar index. Let me just see if I can find it. So this is the concern I was talking about. You had the collapse in the dollar at the same time as you had the rate spiking. That is that Britain, a little flash of that moment of rejection. It's a loss of trust in American assets. And it started with American institutions holding debt, selling their debt, not Japan. Remember, Japan is a proxy of America financially after World War II. Watch Prof. Werner on that one if you have any doubts about that. So going back to what we were looking to show you was also the Dow Jones. And the question is, do central banks that were add volatility or stability to a system? And this is the Dow Jones, what we're looking at, the Dow Jones index, the biggest 30 companies divided by the gold price. And here is roughly when the Federal Reserve was established. Very soon, you went into the roaring 20s and then had the Great Depression. That's a great gift. Thank you very much, the Federal Reserve. By the way, these purple numbers is how many gold ounces you needed to buy the basket of the Dow Jones. At the Great Depression levels, you needed 1.88 at the lows, and it was as high as 18.63. So it literally went to 1/10 of its high. Then we went up to 28.47 to 1965. That was the 60s, the swinging 60s. That Vietnam War moment that I warned about, that was the hyper-indebtedness, and that brought the Dow Jones down from 28.47 all the way down to 0.99. And it was the extreme gold bull market, 0.88, my apologies, 0.99 relative to 28.47. So it was actually lower than the 1.88. It dropped almost half to half that amount. And this is a log scale chart, by the way. And then we've had the financialization of everything post Volcker. And this was peak gold. You wanted to hold gold in the Great Depression. You wanted to hold gold as Volcker were upping the rates. And then every time you could have bought the stock market real cheap. And it's part and parcel of the equity market going down and gold going even higher. But more of it is the gold upside movement. So we got to a peak in 99, 44.93. Call it 45 gold ounces you needed to buy the Dow Jones index. That's unheard of. And of course, that was when it was around $250, and Britain's Gordon Brown sold 400 tons to we don't know who the lucky buyer was, but I'm sure it was some insider friends. So that correction, you got the subprime, we got down to 7 there, and then we got 5.72 during QE. Once the QE started, gold started to stir quite a bit. You might recall that 2011, 2012, even though it was a hell of a depression as far as I'm concerned. Then we rallied back up to around about 217 during 2017 to 22.45. That was how far we dipped on COVID. Not that much. So my whole view is this crisis that they're bringing on us financially wise and in gold ounces to the Dow is going to be far larger than the events of COVID. We'll come back to that point because I'm going to make another point when we get there. We've got to rally back up, So the stock markets were doing well, gold were doing okay. We had 3 years of going sideways in that broadening structure from 2021 till 2024 when we broke again. And now we are selling off. And for me, this goes below 0.99. You will buy the Dow for less than 1 ounce of gold in due course, coming not too far away. And I think you go even lower because of whenever you use maximal leverage on the upside, the unwinding will have a similar disproportionate effect to the downside. And that's going to lead to a rout. You're going to get Times and Newsweek saying the death of the equity markets. That's when you know you're close to the bottom. And then I'd still wait a little longer. You might have one more sell-off. So gold is going to 100% be, in my opinion, the best asset to be holding during this period. And you can see, if you come to the conclusion that was the establishment of the Fed back here, they've only added pump and dump schemes. That's it. And they've played them, and they're the buyer of last resorts at the bottom. There's 3 clear cycles. Each cycle has got larger, has thrown up higher, and has fallen further down. And that is the law of action and reaction. We're talking Newton rather than finance here. So when I take you to the gold-silver ratio, which I will do here, and we come with that knowledge with so much more to fall, I kept warning, and I said it in Cape Town when we spoke with you, people will try jump ahead of the game and jump into future stages. And the stages are possibly going to be longer than you think. Everybody thinks this was the peak for the gold-silver ratio. Don't get me wrong. A lot of people have already misconstrued this very quickly. I am a silver bull. And in time, I will be a far larger silver bull than I am a gold bull. And I hold gold and silver. But phase 1 could extend and be longer than you think, because there is so much of the big money and the created liquidity that needs to get out of a huge bond market, not just in American debt, European debt, everybody's debt. Everybody's debt. Debt as an asset class globally is going to be affected by debt being affected in America. This is the chief leper that we all had to kiss to join and be synchronized in the single largest worldwide coordinated and synchronized event. We all kiss that leper. So there's debt write-offs to happen everywhere that are going to fall right the way down. They may not all have consumer loans, like I was describing on vehicles that America has, on the volume that America has it, but the governments, the municipalities have all overspent what they got in income. And they're all at a point now where things are going to unwind, and it's going to unwind across the board. So this is a very bad news story for the West, but it doesn't mean other places aren't going to feel some of the downdraft of that. If that's to happen, there's going to be a wall of money that has to run into gold that could take gold a lot further than people think. And when it's the big money buying, the key aspect to this gold move so far, it's not retail that's driven this price up. It's central banks, hedge funds, big offices, centimillionaires, billionaires, home offices, family offices, etc. That's where this wall of money is coming from. Government, big money. And we haven't started in the re-rating of the debt system. So we have a technical setup that could happen. It's not a promise. We're talking about the future, but we've had a squeeze here. And this is my one controversial thing. Silver will have its moment, and I think it will, because of the scale of everything, chronically outperform gold, potentially getting into a single digit to gold-silver ratio. But it first might get worse on the gold-silver ratio, because we haven't even started with the proper debt unwind. And this is, the gold-silver ratio is the big indicator of fear. That was your COVID event right there. Every time else, when we had 90, we've sold off. So this is a huge event that has just started. It hasn't ended. It's just starting. The big collapse of the debt market is just starting, and this technical pattern gave us a 171 to 175 range target, which could mean you could have silver at, say, $50, which is where it runs into a bit of resistance, and you could then, on the $170, be already looking at gold at 8.5, 9,700. Look how quickly we took out. I was saying 2.9, you might have a breath. We had a small breath at gold. We didn't have a long pullback for an extended period. It shrugged it off. It had a small technical pullback. Let's just revisit that. We said, remember, you're going to make the big target of 2,900. There you go. That was your pullback. That turned into a continuation pattern. It went higher. Then we said, okay, we've made the 3K. Boom. A little bit of schizophrenia here. But the only solution is gold and back in. We literally just traded in our community the pennant there on a shorter time frame to get more upside. We were highlighting this today. We just closed. That little is there, right there on low time frames, trading to the long side. Upside volatility-based breakouts are continuing being dropped. This market is making a new high. Happy new gold high. I don't know how many it is this year, by the way, Alexej, but that's another new gold high. So let me leave that with you and see what you want to unpack in there.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. We never have enough of those all-time highs. We're literally high from those prices. If we look now at Bitcoin, because I think you also have those one of those charts. I was chatting with some people I know about the performance of gold compared to Bitcoin, and most of them are Bitcoiners, and they said, "Wow, Bitcoin is going to take it away." Do you agree with that? Do you think in terms of performance in the next 6 months up to 12 months, Bitcoin is going to outperform gold?
The biggest buyers in the room have already spoken, and they're not buying Bitcoin in the same degree by any measure that they're buying gold. So when it comes to governmental and the large people, if they are dumping the American debt, they're selling out the hedge funds, those smart, top, big super money people have chosen gold. The market's spoken for that. That said, this is a falling wedge. You did break. You might get a return move. And Bitcoin is one of the other things that will be still standing that's not really deep in the TradFi place. The traditional finance is what they call equities and fiat and everything else. So it's not necessarily going to do badly. And if it ever does get its boots running on, which will probably be while silver is getting its boots running, it could start playing catch up to gold. I'd actually like to do this. I wasn't expecting you to dig deep on the cryptos, but I'd actually like to do this with you, because I seem to remember we made a couple of key levels not so long ago when we last did this draw where we divide Bitcoin by gold. And the key point I was looking for was this. Let's just get that pattern in view and put it in log scale. This was a chart that I was showing, and it was illustrating the fact that Bitcoin has been above this red line for 13 years, almost, all the time. It has been outperforming. We call this a basing ascending grind line. Some people just say trend lines. We're quite specific about our phraseology because it has a real meaning in other senses as well. And we drew this blue level as well on here. This is a downside break of a basing ascending grind line that has held for the better part of 12 going on 13 years. Which is indicating underperformance. We were highlighting the squeeze. And again, we mentioned that there was a key event. When we spoke last, this break hadn't happened. So gold is now currently outperforming Bitcoin, and Bitcoin has surrendered a rate of change that it was holding all the time against gold recently. That doesn't mean it doesn't later go up. And we've highlighted already, shown you the falling wedge and a pop out. And if you are in crypto, you mentioned the crypto sniper. We do have specific cryptos that we think which will even outperform Bitcoin. But the key trade right now is gold, and you've got to choose it. Yes, I have something or some part in those other coins that are statist, big market cap, and are going to play a role in the future CBDCs. But I'm not looking forward to them winning because, again, it's a horrible world when we go UBI and CBDCs. But I'm doing what I need to do to protect myself and my community's wealth. And that's all I can do. While you're talking on gold cross valuations, the other thing we also mentioned previously and has advanced further is that it's a consumer-wrecked environment, and actually there's a contraction, and we believe we're already in a recession and have been since we met the criteria of that. You might recall me saying that, and that they just changed the rules because Biden was hiring a lot of DEI consultants, and it masked the fact that there was actually growing unemployment because they were doing a lot of statist recruitment of people directly into government jobs or into consultancies that earned 100% of the revenue working with government. And we said that's not real employment. This is fluff. This is cultural Marxism and all the other soft topics that weren't deeply productive. And in actual fact, when you have a recession, when people are producing and growing, they consume energy. China will be one of the biggest energy consumers as a workshop of the world, but when their order book is getting smaller, they'll produce less. We even warned on uranium that could slow because the world is slowing. And oil was a bear, and we said the best trade is actually a gold long, oil short. This is the inverted head and shoulders that we discussed back then. Left shoulder, head. Over here, you got your right shoulder. Now, what is this? It's gold divided by oil. And this was a reversal. This was a reversal from the downside. Down here, you only got 14 barrels with an ounce of gold. Now, you've run two of our first targets in a reversal, and you're up at 52. So what's actually happened is oil had a spiller. It eventually gave us our spill. It was lagging and grinding and bit up, bit down, and slipping, and gold was running. So the one half of our trade was absolutely winning. The other one was giving a little bit, but not too much. And then bang, we just dropped a rug pull. The floor just disappeared. And that's your oil market. So let's just show you the oil market, which is the other half of that over there. We'll say goodbye to the yen, which is another fear indicator. And we're highlighting that you don't want to carry trade unwind, by the way, to come next, because a lot of people have borrowed in yen and might have to pay it back. That's your recent oil price behavior. And you can see with the debt crisis, people are calculating on less travel, less purchases, less deliveries, less packaging, less everything. And that affects energy adversely. And even uranium, which is a great way of feeding the beast in terms of your energy requirements, nuclear, and has done well previously, even that has gone down. And I'll just highlight that as well. Just as people are trying to get over the confusion of all the climate and misinformation, we can show you what's gone on in uranium as well. See that sell-off? So energies, everybody thinks inflation trade, just buy commodities. Money is not a commodity. A reserve asset is not a commodity, but gold is regularly classified as a reserve asset. This is a financial default trade. It is a debt-based fail. You go gold. Everybody's going to have less. They're going to spend less. They're going to buy less. That is the Rockefeller tax. That's going to drop because people don't have the money. And it's only when you're having booms that oil can expand and then its price goes up. It will, in the end, with the devaluation of money, eventually go up. But if we're going still into this, and it's not even being acknowledged yet universally for the recession we were telling you in March it was, that you'd qualified the year before that for, we aren't even near even plumbing the depths. This is why we say it's a big, lengthy collapse. And you look at that megaphone, you've got a long way to fall, and there's possibly other issues that are all going to be thrown into the chaos. You might get a bird flu event. I'm not sure we're done with all of that. No one's talking about it anymore. You're going to have rolling bad fortune. And as I say, the banks have got to be drawn into this because they are part of the debt-based system. We aren't even discussing any of these phases yet. Remember the bank collapse of a few years ago? That's not even come into that. debt-based collapse affects everything. It is the foundation of the Ponzi scheme that has been constructed. And that's why this gets worse. That's why there's no melt up. And that's why it's still early in the gold trade. It's not too expensive. You don't have to buy silver because it's too expensive. You can buy a gram for $100. Go and do it. Start with the king, because the big money is chasing the king. Once we start getting into pushing it all out. You also asked about platinum, but I won't jump onto that chart until you're ready for me.
Which chart?
You said you'd like also to hear about platinum at some point, and
yes.
I had it prepared for you. Just a reminder on platinum where we stand. So the biggest producer of platinum is Southern Africa. That's South Africa and Zimbabwe. And a little bit of a history, I suppose, first should be in here. Platinum got killed by palladium and a little bit by rhodium. I need to go back to log scale here. This is a really big time frame. This is technical charts back, long time frame views. So it went into a falling wedge, and it had an absolute spill with the events of 2020. But just as a reminder, gold is 8 times scarcer typically than silver, my apologies. So you will have, let's say you will have 8 silver ounces before you have 1 ounce of gold, between 7 and 8. You will have 20 gold ounces before you have a single ounce of platinum, 20. So actually, if you do silver to platinum, you need 160 ounces found of silver before you find an ounce of platinum. And it's stuck in all the nations people most have issue with. The BRICS nations, South Africa is the number 1 producer of platinum. Russia is the number 1 producer of palladium, and it's part of the platinum complex. And those 2 nations are essentially over 80% of the supply. And it is very precious. It is very unique. And it has been, because of its industrial use in exhaust systems, catalytic converters, and the whole climate change and pivot away from diesel engines and all sorts of things, it got crushed industrially relative to others. I grew up, platinum was 30% to 40%, sometimes twice the cost of gold. And really tough to find. And I'm interested by the fact that Zelensky recently was in South Africa and secured a majority stake in North Platts, which is Northern Platts. Obviously, his billionaire backers already positioning him as the front man for what will be, no doubt, a future bull. And I imagine it's probably Americans' money that he's using to secure it. That squeeze is big, and it's going to start running. This is the monthly. But it will still, the rule about gold still applies. Be first in gold before you get exotic. It is a tiny bit more exotic. In some countries, they still charge VAT on it because of its industrial use, like the UK. I think you're okay if you're in the States and you buy it. But this will run, and it'll run hard. It'll be the first setup. It should run through 1647 and then on and on and on. And once it goes, being a very thin market, it will explode too. So thin markets can just go no bid and gap unbelievably, which when you're on the right side is amazing. Watch out if you're a leveraged trader, of course, especially if you're thinking of shorting it. I wouldn't be doing that. So platinum also looks very, very good. There's your technical setup. We'll wait for the third high as confirmation. That would be a confirming break. When you take out that level, the entry is 1,095. I would get in before, and I would have a hard stop just below the 862, as you can see in this box here. This is one of our tools that we developed for HVF trading that gives you risk rewards and all sorts of things. And it's specific to our community.
Wonderful. I think one of the questions was asked was exactly about platinum. I posted about the fact that we're going to have an interview together, and I think that will make this viewer and subscriber very happy. If I now take back the conversation to the global foreign exchange FX liquidity spike, because you talked about this different early stages of that, right? That could trigger this reset, this financial reset. What currencies are the most vulnerable, and where do you see the fear trades emerging next?
So maybe it's easier to start which currencies are semi-decent. Ironically, year to date, the ruble has been the strongest currency. It's actually been stronger than gold this year. It didn't have the year gold had last year, by the way. I think gold's up 23%. I don't know if that includes today, though. It'll be more. But it's actually the only fiat that's ahead of gold for the year to date. That won't last long, I don't doubt it. But nonetheless, you have to tip your hat to that. So this trade war, where if Russia was bad, the fact that America is doing its damnedest to accelerate its decline, and this is controlled demolition, is going into warp speed state, actually is very positive for Russia. And lots more people are wanting to do deals with China. And by definition, as a sort of second ally, a key second ally to China, who's worked with them, actually Russia's outlook is actually looking more favorable generally. But so that's not me pitching you to go buy rubles, by the way. Gold is it. But in the fiat realm, who's going to relatively outperform? The Swiss franc's been reasonably strong too. And the yen, if things get disorderly and we have a carry trade unwind, I'm just looking again for the yen chart. I might have flipped it to show you the uranium. But the yen is part of the fear. So I watch certain things for collapse. This is why we said it's coming.
I don't see the screen, though. I'm not sure if you want to show it.
Let's get back and share it. I do. So the fear trade items are that I watch. Debt markets, which is the US 10-year is my chosen medicine for that. And then, of course, certain currency pairs. And the Japanese yen is one of those. And by the way, this was our carry trade wobble. Doesn't look like much because I'm on a monthly chart, but we were through 160 and then we smashed down to below 140 to 139. That is just a tremor. That's going to look like a trailer, a 30-second TikTok video for a film. Let's just call it, because if this inverted, this head and shoulders, sorry, not inverted, it's a normal head and shoulders. If this turns and breaks here, this could be a disorderly decline in American currency as well. And you've got to remember, the carry trade is never fully unwound in most of history. We've had scares. And it's American institutions, but not solely American institutions, but that are part of the biggest. They've used the yen, and I refer again to Prof. Werner's interview. We interviewed Professor Werner of Princes of the Yen fame, who wrote the book and is alleged to be the man who named the phrase quantitative easing, the economist who named it, who was in Japan. And he has said and studied very intensely, and it was a fascinating interview. Go look the Market Sniper, Professor Werner, if you're interested. And we talk about it, and he says that since World War II, inherently, the Japanese financial system has been a proxy of America. They have a dominant foot on its throat since that era. So that's why I knew when they started saying it was the Japanese who sold the treasuries that we were being lied to. If they ever did, it would only be with the approval of the American markets, not anyway. And the fact that they have 1.1 trillion shows how deeply embedded they've been a buyer of last resort. In fact, short sidebar on that, you look at all the proxies that are the biggest climbing holders in treasury debt. And you have Japan, I've already mentioned, it's almost a proxy. You have Belgium, Luxembourg, Cayman Islands, and the United Kingdom. Okay, these are toxic banks. The United Kingdom hasn't done a single accurate, beneficial economic footstep in the last decade. Everything they've done has been destructive. And that goes for Merkel in Germany too. But I'm just highlighting they're the friends supporting their toxic American friend. And these are proxies. These are proxies for supporting the system. And of course, the Fed itself is one of the biggest holders of the T-bills. So what happened, very simple explanation of the carry trade, which we have yet to see meaningfully unwind, which would be absolutely catastrophic, was that Japan, post the 80s and early 90s, had a huge crash and have run exceptionally low interest rates. So America used this, and I'm talking about hedge funds, institutions, banks that were capitalizing their profits and socializing their losses as they did in subprime, were borrowing cheap in yen. They were then converted to dollars that sold the yen off, that kept downward pressure on the yen, bought dollars and put them either in treasuries where they earned a much higher yield, or even the Mag 7 and used it as cheap financing to buy go-go stocks. Now, when you start to have disorderly strength in the yen and you have devaluation of both treasuries and or Mag 7, and we've had both, what happens is people get shaken out of their long-term trades, and they have to sell dollars and sell the treasury if they were invested in treasuries, or sell the Mag 7, Apple, etc., sell the dollars, send yen back to pay off their loans that they've been servicing on a low interest rate. Remember, people that loan it still will have charged a margin. So we've seen a rise in interest rates on Japanese debt at the same time. So there is already the feel to me that, and forecast, Francis Hunt, take note, look me in the eyes. You'll start hearing about Japanese yen trade unwind again if this continues and breaks that blue line. That's what I'm saying. And it's going to be much bigger than whatever little taster you thought you got in August of 2024. And that will be further pressure on the dollar. It will be very negative for whatever asset was held, which I'm calling either the stock market, Mag 7, or the treasuries, depending on how risky they wanted to be. They either put it into debt markets and skim the differential. Remember, most of the time, the yen was has been going down. If we look at this in value. So the fact that this chart was going up means you were paying less back. The dollar was being stronger. But if that turns and they have to pay back that debt, and with it, the derivative risk of all of that, boy, oh boy, you're going to be hearing about banks going bust. You're going to have equivalent of long-term capital management vibes, only on a much bigger scale, with every investment bank that has participated in this cheap funding mechanism, because this will be a major unwind. We haven't heard enough about banks, hedge funds, and institution bankruptcies. That is going to be a stage that is still to come, and you're going to hear about the carry trade. That's my prediction for you today.
We did actually start, especially about everything which is repo related, about hedge funds having big problems. And there's also this chart I wanted to talk about with you, which you might have seen on X going around, which is the global M2 liquidity that is preceding up to 6 months. You can see the juxtaposition of the movement of the price of Bitcoin and the M2. And that is an indicator that also I think Henrik shared with me in the last follow-up interview that we had a week and a half ago. That is kind of one of those, well, maybe call it cope, or I don't know what you want to call it, or maybe actual valid indicators. It's up to you to judge. I would like to have your take on that. How much of a valid indicator or signal is that chart to you?
I think I've only just seen it in passing on a tweet. I'm not sure I'm best equipped to even respond.
Should I show it to you?
Yes, please. I'm going to put in M2 money stock anyway in the meantime. And it does show some element of increasing. But I want to just refer back to a lot of what I've said. People are going to misread this on account of not understanding that in actual fact, they've got way too much money they have to roll, for which new money needs to be created. And that money is already committed to avoiding failure. Because when the 9 trillion comes due, you either pay the 9 trillion off in full or you refinance it. And they can't pay it off in full. They need to refinance it. So any increase in liquidity should be viewed through the spectrum that there is a massive demand for liquidity to rehome a massive amount of debt that's being in rollover state. And that is a big thing. So everyone automatically assuming that liquidity is being pumped into general assets outside of the debt market, and that it's going to pump the stock market for a second surge, and it's going to throw Bitcoin up. Don't get me wrong. I still said to you, Bitcoin can go up. It's got a falling wedge. And when you get the debt collapse and everyone understands it's the new system and they start talking about chasing in for the reserve asset, it can go higher. And we've got cryptos, as we say, that what we think will go even higher, that we've made very strong target calls on that. But that liquidity doesn't belong necessarily to the Bitcoin market just because it's going up there. There's much bigger claims on it right now that are absolutely urgent, otherwise debt default. They might even do a surprise debt default. So here's a couple of predictions for how America deals with not being able to deal with the debt. They say, you're a trade enemy with us. You've run a surplus that's overproduction on your behalf. We don't pay you interest on your treasuries anymore. They can just decree that and say, what you're going to do? Come bomb us? We've got a defense. We can defend. We might not be winning wars in Afghanistan, but we can defend our own borders still. They haven't fallen apart at that level yet. They're still spending, more than most people on their military-industrial complex, although most of it probably goes in bungs and arm dealers and enriching the political classes that vote for all these wars. Let's not ever forget that. But that point aside, they can do that. Capital controls. They can just lock it in and say, you can't sell. Can't do this, you can't do that. This amount of money can go in, this amount of money can't go out. If you're in the West, full stop, exit taxes are coming. In some cases, they're already in play. They're going to be more broadly discussed and brought. They're going to trap you in there. They want you as a captured rat where they can extract everything from you. They are all bust.
Let's talk about this, because I think in Europe it's actually quite relevant. There's obviously the digital euro, the CBDC, but there's, as you also just mentioned, the exit tax. We see it here in the Netherlands where I live. We see it in France. We see it in many more European countries. But also what we see now is the von der Leyen statement that she made a few weeks ago about monetizing the saving accounts of European citizens to finance the Rearm Europe project.
Pensions are the big honeypot that every government minister wants to grab, whether you're in South Africa, in Europe, anywhere. Big private pensions, that actually money that belongs to somebody else, but that is in wrapped, acknowledged by the government, tax-free vehicles, is the big money pot that they all want to weaponize and use. And they're going to force you into investments. It's going to be like war bonds. War bonds were what America sold, and it will be the equivalent of that, because if the Europeans are telling you they want to militarize up to protect themselves from this vicious, aggressive Russian nation that just wants to steal their cities from them and take over everything, this totalitarian surge, whatever story they're creating, war bonds will be it, and they'll use your pensions for it, and you will not get a good return. That is the asset that everybody should be dumping. I would short sell anything that gets created by the EU to militarize as an asset class. It's like buying debt bonds now. Essentially, you'll become a debtor to the state. And then they'll say, yeah, we'll pay you this. And then they'll inflate and do everything they've done. People have to understand, government is your financial enemy, and they have run out of money. So they're going to be hungrier than they've ever been before. They're going to go into full-blown scavenge mode. And they're going to do just like Donald Trump. They're going to get aggressive and totalitarian about it, because it's the only way they can hide the fact that they're going ape about stealing your money and going totally draconian. So what do? They act aggressive. If I'm lying to you, I start shouting at you and saying you're an idiot and getting personal and saying, and what you're going to do about it, and act aggressive to obscure and throw dust up in the air that it was actually me who stole your wallet. That's what's going on. How dare you accuse me of this? This is totalitarianism, and it's a war. It's a financial war aimed at stripping your assets for their greater goals and their extractionary schemes, which invariably involve wars, the military, and many other things. This is nothing new. They've been doing this for a long time, but now they've lost the overdraft that allowed them to dip deep in, the bottomless overdraft. It's now got a hard limit. The other side is no longer taking the other side of the trade. Nobody in the free market is willingly bidding. Everyone's saying, but the Fed can cut rates if this is a bigger recession, as you say it is, and then it'll be liquid. They could cut it to 1%. No, because that means the bond valuations are spiked up, and there's trillions of them. Who's buying all of that? And at super high prices, doing a not-for-profit purchase, chasing the bid up on the bond. Nobody's going to do that. Nobody's got the depth of pockets, and nobody's stupid enough who has. So it's not going to happen. It's going the other way. Everybody's running for what preserves your capital in what's going to be a hyper-stagflationary environment, which means consistently very high inflation that is going to be understated by your lying state who's waging war on you, and a very stagnant economy because there's not enough liquidity around in the normal people, this man in the street people. And this is it. It's the two bubbles economy. The man in the streets have been stagnating for a while, in fact. The minute we globalized, labor increases have been very, very slight. But asset prices have continued up. That's why people can't afford homes today. The younger can't afford home. The devaluation of money which means the assets have gone up, and the fact that wages have not gone up in the same rate because of globalization. It goes to the lowest cost denominator, slave labor, somewhere in the East. That's what's happened. Now they want to bring it all back. You can't reverse this. There's too much debt now. So it's a debt-based collapse. That's what everyone has to realize. Your government is your biggest enemy. Right now, your government and their policies are all designed to trap you, strip you, and contain you. It's totalitarianism, it's financial warfare, it's going to turn physical and social. And in the UK and in Germany and many countries, you're already seeing this. They're putting people for jail for 3 years for social media posts, indigenous European people, and they're giving murderers off for 18 months suspended sentence for stabbing people. This is a two-tier everything. It's designed to show you who's going to get beaten up. You shouldn't stay. But it's my home. I'm going to fight to the last. Bad emotional sentiments. If you're a good executor and you've got the right attitude, you'll be successful anywhere. If you're in the wrong environment, the best surfer in the world's not going to do a 10 out of 10 ride out here in Cyprus, where I am now, on the flat sea. But I might get a 5 or 6 out of 10 in Hawaii, even being a pretty damn average surfer. This is it. Environment matters. You're in the wrong environment if you're planning on seeing this through in Europe. I've said this enough times, and in Britain and in the West, full stop. US, Canada, New Zealand, Australia. The English-speaking nations are going to be the hardest hit. The white European nations are going to be the hardest hit. You need to think about locales where you're not going to get a perfect one, but you can see this out.
So where would you be then? Which are the top 3 countries you would be in for this scenario?
So first, let's just remind everybody there's no perfect solution in this. There isn't Narnia. I can't spell you Narnia, where everything smells of rose petals and everything in the world. And this is a global leper colony, or a worldwide one as well. Everybody to some degree has kissed the leper. But for different things, if you're just all about security, I was watching some influencer with fast cars and a Miele watch who got robbed, who was a UK guy, always driving in flash cars and Instagramming his Miele with a Ferrari badge and all of this. Well, he got robbed. And then they came back because the Miele wasn't there at the time. He was having it serviced or whatever. They came a second time. He's moved to Dubai because he's all about security right now. Now, there's lots of reasons why I don't like Dubai, but if you want 100% security, that'll be your choice, and you can still fly to Europe fairly easily. There is going to be capital formation. They're setting about putting all sport there. It's going to be bread and circuses, but to me, it's about the Middle East, the fake, phony Middle East. There's a lot of dark aspects that I don't like. Singapore, I saw how they were as CV19 scares the Jesus out of me, but if you want to be left alone, not bothered, and if you comply generally with their rules, very safe, and being able to do business, it's a safe place. Doesn't quite cut with me. You know where I am. I was with you there in Cape Town. I like it. I understand it. But if someone says, did you just tell me to go to South Africa? Isn't it the murder capital of the world? Isn't it this? Isn't it that? There's 120 different reasons. But actually, some of the things that were the reasons actually are very supportive. You can disappear in the cracks there. It's totally self-reliant at a food level. We know where the crime hotspots are. It's not where we are. But, it's still a difficult sell to a man and his wife who's never been there. I'm not telling you to go there. Latin America, Bali, Indonesia, the demographics are going to drive the growth. If you're you go to a country where they're generally not aggressive towards you as a white European. You go to Malaysia. I have a friend who's married a Filipino. They love him over there. He's Scottish. He's like it's almost like the white guy's the hero. Hello, he's a mini celebrity. And they're not aggressive. They do their Thai boxing for sure, but nobody's attacking him, and they work hard and they've got a good culture. You've got to leave home. You've got to leave home, but you can still visit it anytime you like and see your friends. Don't be the last one to switch the light out. That choice is your personal choice. We have a few things. It's a too detailed conversation for me to get into many other ways. But if you set up a corporation, you can work online. AI is going to change the world. Stay modern, stay hungry, keep earning, keep living within your means, and keep stacking in gold. I'm telling you, you're going to be wealthy, and you can do businesses with a demographic growth where they are not on the wrong end of a baby boomer generation, where everyone's only been having had 1 or 2 kids for the last 2 decades. They've got a surge, and they're going to be doing a lot of exciting, interesting things. They work hard. There's reasonable, low crime generally. that could be a place for you. There in Bali, Indonesia, Singapore area, Latin America, Uruguay is very safe. So that's a different discussion that maybe goes beyond it. But the key point is recognize where you are and the trend, because you think your standard of living's up here. It's being eroded, and other places haven't been priced in for how cheap it is. You know what quality steak you had for how much in Cape Town, and you know how well you ate. And
it was a steal, definitely.
Yeah, and did you feel badly served? Was the service terrible?
Everything was beautiful and wonderful. I can only recommend to people, go to South Africa and see it for yourself and experience that. It's definitely high on my list.
Yeah, and you can buy a home there still for reasonable prices. In due course, your currency will collapse, your property will become unsellable, other people will leave, the market will be smaller, there'll be an overhang of people wanting to sell and move out, and you're going to have taxation. The later you leave it, people who sell homes will have additional taxes added to it. You'll have an immigration exit tax if you're going on holiday and you don't have a return ticket. They're gonna realize it, and they're gonna keep trapping you. Once you start down the totalitarianism, the financial warfare on your citizens, it only gets bigger, because it doesn't bring in growth. It doesn't bring in millionaires, billionaires, and wealth, and it doesn't bring growth. It brings siege mentality, and you end up with the sleepiest left behind. Don't be the sleepiest. Don't be left behind. Move soon ahead. It's the cheapest. The first loss is the best loss. I'm someone who had to leave my home. We were crazy. We had terrible political issues. You're well documented in terms of apartheid and everything. Then we had to rebalance for race. I couldn't get a job. I had firsts in an MBA and all sorts of things. I had to move to go get better. But now I can go back there anytime and be a relative wealthy person and live the best life as a tourist. And that's the best way. That is the best way. And you can reduce tax once you give up your main slave master. So those are my wisdoms. I'm going to need to slip away. I hope this has been a useful update. People who want to find out more, the Market Sniper YouTube channel. We'd love to have you go and have a look, watch something. Go look for that Prof. Werner discussion about Japan. If that interested you, just put the Market Sniper and Professor Werner. And at any time, feel free to book a call and using these fine gentlemen to purchase your gold. They're doing record business. They deserve to. They're awesome. We did great content together, and you'll get it delivered. And gold is, right now, your safety ticket on everything. If people, I can reduce this whole discussion down to one word. It's gold.
Perfect. Beautiful. Thanks a lot, Francis. I will link all the things that you just mentioned also in the description. I am very grateful for your time, all the knowledge nuggets, and I hope to speak to you very soon again.
Absolute pleasure. Look forward to that day.